Hey guys, welcome to Alpha Logic, where I review some of the best wisdom of all time. My name's Gabriel, and this week we're going to be reviewing Rich Dad Poor Dad by Robert Kiyosaki. Now, before I get into the review, I just want to say that I am not a qualified CPA, so please take this information as a review of the book and not legal, accounting, or tax advice. So let's take a trip back in time to talk about taxes and where they came from. Originally, England and America had no taxes from the government. The only times people were taxed was when the countries were going to war. The king or the president would ask people to give money to help. In England, the taxes were imposed on the citizens during the fight against Napoleon from 1792 to 1816. America imposed taxes during the Civil War in 1861. Now, England didn't pay taxes permanently until 1874, and in America until 1913 through the 16th Amendment. So one thing people don't realize is that initially the taxes were imposed exclusively on the rich, known as Robin Hood theory of economics. As the government grew and its appetite for money grew stronger, it eventually started taking money from the poor and the middle class as well. Now you might be asking yourself, why is all of this important? And the reason is because the tax loopholes is what the rich use to ensure that most of the money they make is kept in their pockets. Now, what the rich use to keep most of their money is called corporations. So you have a corporation that you set up, which is pretty simple. You can Google it for instructions on how to do it. That corporation owns assets, and the assets produce income. Then the money that the corporation made is used for business expenses, aka tax deductions, and whatever money is left over after all of the business expenses is what you're taxed on. So let's assume I create Raffi Rents LLC, a real estate investment company. And I own 2 apartment buildings, each of those buildings making me about $100,000 a year. So from those $200,000 that I make from them, I spend about $120,000 on business expenses, such as the business trip to Hawaii or a new Ford F-250 that the company bought me for business purposes, meaning there's only $80,000 left to be taxed. I then pay myself $48,000, which is taxed as income at the 25% tax bracket, as the CEO of the company, and give myself a $20,000 bonus, which is another tax deduction. $68,000 total, leaving $12,000 left to be taxed by the government. Now, I just want to say that this is a very oversimplified example, and there's a lot more to it than this, but this is just for illustrative purposes. Now, another thing you need to understand is the difference between an asset and a liability. So assets are as follows. You have businesses that don't require your presence, stocks, bonds, income generating real estate, royalty from anything you've copyrighted and make money on, such as books or music, and anything else that produces income or appreciates in value. Now, liabilities are as follows. You have boats, a house that you can't afford that's costing you money every month because you don't have tenants living in it, cars, and anything else that takes money out of your pockets. So what the rich do is they limit their liabilities and throw all of their leftover money into their assets column so that they have more money in the corporation. This book is actually pretty similar to The Richest Man in Babylon, where you're essentially using money as your employee to go out into the world and work for you and bring you more money back. Alright, so this has been Rich Dad Poor Dad by Robert Kiyosaki. If you guys enjoyed and are interested in purchasing it, there is a link in the description below. It is an affiliate link, so I do make some commission, but there's no extra cost to you. Be sure to subscribe for more and like the video if you guys got any value. Thanks for watching, and I'll catch you guys on the next one.